We now bring in Chief Economist at PSG Financial Services, Johann Els, to assess the impact of the Middle East crisis on South Africa. A very good afternoon to you, Johann. Thank you so much for your time. I mean, we've just listened to the Statistician General, Rusenga Maluleke, talking about how the country's economy has shown recovery and resilience after South Africa's recorded its fifth consecutive quarter of growth, expanding by 0.4% in the fourth quarter of 2025. Was this in line with your expectations?
Yes, it was a touch higher than our expectations, 0.4%, but the overall growth for the year was pretty weak. It was positive, yes, that's true, but weak growth. If we think about the needs of the South African economy in terms of employment, in terms of the fiscal situation, reducing the debt ratio, etc., 1.1% is weak growth. We need significantly higher. And to touch on what you said, the Middle East crisis, yes, that presents negative risk. The significant rise in the oil price, that's a big input in terms of business activity, consumers. So a rise in prices like that would dampen economic activity. So while it's very difficult to make forecast changes at this stage, we don't know how long that war will last, we likely going to have a negative impact in terms of economic growth globally and in South Africa.
As you speak about the factors dampening economic growth, with the current geopolitical climate introducing a significant amount of uncertainty, those warnings that should the military action in the Middle East be prolonged, South African businesses and consumers will feel the impact through even higher fuel prices, which perhaps translates into a weaker path for the rand and higher inflation. What's your take around that?
Yes, absolutely. I think as the petrol price recoveries are unfolding at the moment, it looks like there could be a fairly significant petrol price and diesel price increase coming in April. At the moment, it looks like it could be anywhere between 5 and 7 rand per litre increase, and that's significant. What we have found, though, in the past, even if hostilities continue in the Middle East, oil prices fall back fairly quickly. Even if that war continues for longer. So I don't think we should expect significant further petrol price increases over the next several months. There will be some reduction coming pretty soon. But for now, we do realize that interest rate cuts that were expected from March onwards will likely be delayed.
Yeah.
And then, of course, it will depend on how that war unfolds and how long it will last. But for now, yes, significant impact in terms of petrol prices, significant impact in terms of inflation. Hopefully that will be turned around in coming months.
So in assessing the impact of the spikes, there are also concerns that it could deter anticipated interest rate cuts initially expected from March onwards. What does the current economic environment call for, more so as we assess the immediate concerns for policymakers and investors?
Yes. The Reserve Bank's policy stance has been around a lower inflation target, around 3%. Now, as I said, there might be some impact on that in coming months. But generally, inflation has settled closer to 3%, and I think we'll revert back to that. That means there's still room for rates to be cut in South Africa. Having said that, and we talked about weak economic growth earlier on, it's not the task of the Reserve Bank or interest rates to accelerate growth in South Africa. The main reason why growth has been pretty weak is policy, weak implementation of policy, and also lots of structural constraints. We've managed to sort out the electricity constraint. Unfortunately, government has brought in the private sector to help out there, and now the private sector is helping out in terms of water supply, building the electricity grid, helping out in terms of logistical issues where Transnet has been struggling. So it's an ongoing improvement, but it takes time. We're not there yet. It takes some time. But yeah, in terms of your question, I do still think that there's room for interest rate cuts later this year. They have been put on hold by this crisis now.
You've mentioned that even if hostilities continue, like we've seen in the past, the oil price does fall back pretty fast. And, some encouraging news with the fourth quarter of last year showing positivity in terms of growth. Despite the uncertainties over the global economic environment, I mean, is there more of a silver lining at all for South Africa's economy, more as we're learning that a resolution is perhaps in the pipeline, with US President Donald Trump saying that the war will soon end?
Yes, there is. We've come a long way over the last year or two. we're improving. South Africa is actually in a slightly better position at the moment to handle these global crises than what we were 5 or 6 years ago. We've become a little bit more resilient. Growth is picking up. The private sector's role in the economy has been rising strongly, and that helps. We've got some ratings upgrades, and there's perhaps more ratings upgrades coming. We're out of grey listing. Confidence is picking up. And over the last few years, we've seen inflation settling lower, and we've seen those interest rate cuts. So there's a bunch of reasons why we should be coming through a crisis like this somewhat better than in previous times. And the forward-looking path also looks a little bit better, given that increased role of the private sector, given prospects for better growth down the line. We're not there yet, but it's coming.
Very well. Thank you so much for that as we wrap that discussion up with Johann Els, Chief Economist at PSG Financial Services.